A lot of action for you in the past few days on these investments in ride hailing. As we look ahead to the next phase, what's important in this space?
What's important in this space is for Uber and Lyft to have a great IPO. And I think you have next generation companies, for example, companies like Lime, which is the #1 scooter share in the world. And delivery, certainly companies like Ease.com that delivers cannabis, and then Grin, that's the #1 scooter share in Latin America. And I think this on-demand share economy and delivery is going to be a very hot space.
But I mean, is it the amount of load that the drivers are carrying, delivering things other than people, delivering food, et cetera? Is it extensions into areas like scooters? Is it autonomous driving to change the economics of these companies? Is that what's going to get them closer to profitability? Of, say, even just those things, what's the most important?
I think what's the most important is you got to have a very long-term view, very much like, Amazon's story that, took 10, 20 years. I think companies like Uber and Lyft, their margins can literally double, triple as autonomous cars kick in from probably next 5 to 15 years. And it will significantly improve their profitability.
Bob, you got Lyft increasing the IPO range to 70 to 72 per share. We're going to get those final numbers later today. What do retail investors need to know here? Because it definitely seems to be a lot of excitement, but not every tech IPO in recent history has been so good for those retail investors. What they need to
be assured of is they're not overpaying. So we're all very excited that Levi Strauss has held up very well. That's a really good sign. But the market's been closed for 4 months, so there's a lot of pent-up demand. The stock market's up 12% in the first quarter. That's a real big help. So there's a lot of nice tailwinds. I think what I keep hearing from the retail people are the valuations. So David, let me ask you, last round of funding for Lyft was $15 billion. Now there's reports they could try to value it at $22 billion. We're interested in the retail investors who are going to buy this. What justifies a 50% higher valuation than just a few months ago in the last round of funding? Is there something fundamentally that's suddenly changed about this company?
No, I think when you look at the software SaaS companies that are trading at 10x trailing revenue, they're growing at 50% a year. Now, companies like Lyft is growing double that pace. But then their margins are probably half of the software company. So that's kind of even, Knieven. And so 10x trailing is a pretty good benchmark. And with $2.2 billion, that Lyft did in 2018, multiplied by, 10, you get $22 billion. And so I actually think it's very fairly priced from the comparable perspective in tech.
David, Lyft views social responsibility as sort of a key part of its brand. Some people roll their eyes at that. I'm just curious, how important does that become both for their customer base and now for their shareholder base?
Well, I think it's very important because I think it's certainly one of the reasons why they were able to gain share, particularly in the United States. And I think, the ones who are using Uber and Lyft are, millennials and Gen Z. And, these are the generation that, may not buy their own car ever. And I think, the social awareness, the consciousness, climate change, global warming, these are all very important aspects to, this Gen Z and the millennials. And so I think it did help Lyft to have that positioning.
Bob, Lyft spent a lot of money on marketing and general administrative costs in 2018. I think it was something like $1.2 billion or more when you look at it, more than half of revenue. A lot of times investors with an IPO like to see a pathway to profitability or at least some way to get control over those kinds of costs. As I look at this S1 kind of year to year, the marketing costs are pretty much keeping up with the revenue growth. So What kind of skepticism are you hearing, do you expect for this type of company, especially because it's not even number one in its market?
Yeah, I think the concern is it's a long, long path to profitability, if at all. So $2.2 billion in revenues, $911 billion in losses, and no obvious way to really get over the goal line. Look, losses in theory can stay for years and years until investors suddenly start caring about it. And we saw that in 2000, where suddenly people cared very much about a certain amount of revenues being made. If you didn't, they knocked the company down. And then they cared about losses that were excessive. So they'll reach a point here, and we're going to have a test of the market. 3, 4, 5 months from now, when we get 60, 70, 80, 100 of these IPOs that are out of lesser quality and lesser well-known names than Lyft, we're going to have a test because people are going to be forced to figure out what they want to own and don't. Stuff is going to drop. That's my concern. Lyft is not the first one, so they're trying to get a 50% valuation above the last round of funding. Uber is talking about the same thing. $78 billion last round of funding. I hear numbers $120 billion. And I guess, David, that's what I'm concerned about. 4, 5, 6 months down the road, how long can you keep doing that? How much more vig is there in this game?
Yeah, David, to that point, I mean, go ahead.
Well, I don't think the last round. Yeah, I don't think the last round valuation is relevant. What's relevant is compared to other tech companies, and you look at the comparables. They're right in the fair market zone, and in technology, you have companies like Amazon. 10, 20-year stories. I mean, in 2001, Amazon only had $3 billion revenue and was losing $1.4 billion. $1.4 billion in 2001. In 2019 numbers, those are bigger losses than Uber and Lyft in 2018.
David, you're invested in Lyft. Will you stay invested in this company or stay invested in Careem as that gets taken over by Uber, or are you going to pull your money out and put it to work somewhere else?
Oh, I think I would stay in. I think both of these companies are going to continue to grow. And as the population gets younger, there are more and more people coming online who are not going to own cars and who are going to share ride.